Hey everyone, and welcome back to the Violet Vault. Look, we all want our money to work harder for us, right? We're all looking for those smart opportunities to build a better future. But here's the thing. Out there in that search, there are some really clever traps set by people who are absolute pros at deception. So today, we're going to build your defense system. We're going to make you fraud-proof. You've been there, I know you have. You see an ad or get a tip. It promises insane returns, guaranteed, with practically zero risk. And that little voice in the back of your head just goes, wait a second, can this actually be real? That feeling, that gut instinct, that is one of the most powerful tools you have in your financial toolkit. And in this explainer, we're going to sharpen it into a razor's edge. And make no mistake, this isn't some rare thing that only happens to other people. It's become so common, so widespread that some experts are literally calling it a new pandemic. It's huge. So here's what we're going to do. First, we'll dissect how these scams actually work. Then we'll get inside the mind of the person running the scheme. And, most importantly, I'm going to give you the simple statistical tools to spot the lies from a mile away and build your own financial shield. You ready? Okay, let's jump right in. All right, so the very first thing we need to get is how these people hook you in the first place. It's not about threats or force. Nope, it's all about seduction. They play on our biggest hopes, our dreams, and that very human desire to find a shortcut to financial freedom. Just think about the biggest, most infamous frauds in history, like the whole Bernie Madoff scandal. It didn't start with someone twisting your arm. It started with a whisper, an irresistible offer. Hey, I've got this exclusive opportunity, a secret strategy. I can get you these steady, amazing gains. The whole thing is a performance, designed to make you feel special, like you're being let into an exclusive club. And just like that, your guard comes down right when you need it up the most. So, what's really going on behind the magic curtain? How do these things actually operate? Well, the most classic, the most common, and honestly the most devastating model is what's known as a Ponzi scheme. The definition sounds almost too simple, doesn't it? It really just boils down to that old saying, robbing Peter to pay Paul. There's no secret sauce, there's no genius trading algorithm. The entire operation, the whole shebang, is just shuffling money around, taking cash from the new guys to pay profits to the people who got in earlier. That's it. And this breaks it down perfectly. It happens in 4 totally predictable stages. First, you've got the lure, those big, juicy, risk-free returns. Then, the key step, they use money from new investors to pay off the first round of people. Those early investors are thrilled. They start telling their friends, this thing is real. That's step 3, the false trust. Word of mouth spreads like wildfire, and a trickle of new money turns into a flood. But here's the thing about the math. It's ruthless. A Ponzi scheme needs more and more and more new money to stay alive. Eventually, you just run out of new people. The collapse isn't a maybe. It is a mathematical certainty. It's a ticking time bomb. Okay, understanding the mechanics is one piece of the puzzle. But if you really want to get good at spotting these things, you've got to understand the person behind the controls. You have to get into their head. I mean, you gotta wonder, right? Why on earth would someone knowingly build something that is 100% guaranteed to fail, destroying countless lives, including their own? It's gotta be more than just simple greed. And, well, it is. Now, this is where it gets really fascinating. Researchers actually interviewed convicted fraudsters, and what they found is pretty wild. For a lot of these guys, it wasn't just about getting rich. It was about the thrill, the ego. They actually talked about their love of the chase. They saw themselves as these brilliant masterminds, outsmarting everyone, the investors, the government, you name it. This mindset is, well, it's both fascinating and really disturbing. They don't think of themselves as criminals. They see themselves as entrepreneurs running an illicit enterprise. They're driven by this deep-seated fear of being a nobody, of being insignificant. And how do they sleep at night? They rationalize it. They tell themselves their victims were just greedy and got what they deserved. In the end, their own need for status and profit completely overrides any willingness to not cause immense harm to other people, all while they see themselves as the hero of their own twisted story. Okay, so we know how this scheme works and we have a peek inside the fraudster's mind. Now let's get to the good stuff, your toolkit. We're gonna look at the numbers because a person can lie to you all day long, but the data tells the truth every single time. This right here is one of the single most powerful red flags you can ever learn to spot. Real investing is, well, it's messy. The market goes up, the market goes down. If you chart it, the line is going to be jagged and bumpy. That's normal. But fraudulent returns? Oh, they look beautiful. It's this unnaturally smooth, steady climb month after month after month. I'm telling you, financial reality just does not work like that. That perfect smoothness isn't a sign of a genius investor. It's a giant blinking sign of a fake. Let's make this crystal clear using Madoff's actual numbers. This chart shows the win rate, the percentage of months that had a positive return. So the S&P 500, a benchmark for the entire US stock market, was up about 65% of the time. Okay, a big index of fancy hedge funds, a little better, about 79%. Now look at Madoff, a staggering 93%. It's so far outside the realm of possibility, it's almost laughable. It's a massive statistical outlier. Let me put that another way for you, because this really drives it home. Check out this ratio. For every single losing month, Madoff's fund claimed to have over 12 winning months. 12 to 1. The actual stock market, its ratio is less than 2 to 1. The numbers are just too perfect. They are practically screaming at you that they're not real. So, we've seen the trap, we've seen the mechanics, we've peeked into the psychology, and we've uncovered the statistical lies. Now, let's put it all together. Let's build that practical, powerful financial shield you can use to protect yourself and your family. And here it is, your go-to checklist. First, are the returns way too high and way too consistent? Red flag. Is there a weird lack of volatility? No down months ever? Big red flag. Is the strategy a super secret formula they can't explain to you in simple terms? Huge red flag. Are they pressuring you, telling you this is a limited time offer and you have to invest right now? Run away. Always ask for official documentation, like from a third-party custodian. And finally, just trust your gut. If that little voice in your head says, this feels too good to be true, listen to it, it almost certainly is. And that really is the bottom line, isn't it? You don't need an advanced degree in finance to protect yourself from this stuff. Your greatest defense is something you already have. It's simple, it's powerful, and it's free. It's informed, healthy skepticism. The goal here isn't to make you afraid of investing, not at all. It's to make you smart, to make you curious, and to empower you to ask the tough questions with total confidence. Now that you have this knowledge, you are in such a stronger position to navigate your financial life. So, my question to you is this. What's the very first step you're going to take to protect your financial future after watching this? Maybe you'll take a second look at your current investments using this checklist, or maybe you'll just make a promise to yourself to always ask one more question before jumping in. Whatever it is, let me know down in the comments. I'd love to hear from you.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's going to make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
You know, not every crime happens in a dark alley. Sometimes it happens in a quiet conversation. A crime built on a secret, a tip, a single $1 million whisper. Today, we're going to pull back the curtain on the hidden world of insider trading. It's a pretty wild question, right? I mean, when does helping out a family member cross the line from just being a good brother or sister into a serious felony? That is the exact line we are going to trace today. And it all starts with this number right here, $1.5 million. That's the actual profit one man pocketed from trades based on information he was never, ever supposed to have. And this isn't some hypothetical. This is a real figure from a real case. In that case, Salman versus the United States is going to be our guide. It's a modern family drama that really, truly redefined the rules of Wall Street. And, believe it or not, it all started with a simple tip between brothers. All right, so let's unpack this family drama. It's a story that's really about loyalty, family obligation, and ultimately a massive breach of trust that created a $1 million secret. So here's how it all went down. It was basically a chain reaction, like a game of telephone with illegal stock tips. First, you've got the insider, Maher. He's an investment banker, and he had a legal duty to keep his mouth shut. But he talks. He tips off his older brother, Michael. So Michael becomes the second link in the chain, and what does he do? He passes that same valuable secret on to his brother-in-law, Bassam Salman, who then actually makes the trades. 3 people, 1 very illegal secret. So how on earth did this simple family favor spiral into a full-blown federal crime? Well, to understand that, we need to dissect the tip itself. We need to look at the anatomy of it. What legally makes a piece of information insider information? Okay, so first, you have what's called the tipper. This is the person on the inside, right? The one with the secret. In our story, that's Meher Kara, the investment banker. He had a fiduciary duty, which is just a fancy legal term for an obligation of trust and loyalty to his company and its clients. His job was to keep that merger info completely confidential. And then on the other side, you've got the tippy. Now, this is anyone who gets that illegal tip. And here's the crucial part. You don't have to be the first person to hear it to be in trouble. In this case, both Michael, who got the info directly from his brother, and Salman, who got it secondhand from Michael, are both considered tippies. Why? Because they knew where that information came from, and they knew it was hot. Now we're at the absolute heart of the matter. This is the part that trips a lot of people up. For insider trading to be illegal, the law says the tipper has to get some kind of personal benefit. For years, people argued this had to be something tangible, a briefcase full of cash. But what if you just give the tip away for free to help out your brother? What's the benefit there? And this is where the Supreme Court came in and delivered a powerful, unanimous answer. They said making a gift of that valuable information is the personal benefit. It's the good feeling you get, the personal satisfaction from enriching a loved one. With that one sentence, the court basically slammed the door shut on the "I was just helping my family" defense forever. Okay, so we know it's illegal. We know why it's illegal. But that leads to a huge practical question. How do regulators actually hunt for and catch these people? Exactly. I mean, it's not like these folks are usually caught on a secret recording or doing a shady back alley deal. The proof is rarely that obvious. So how do investigators connect all the dots and actually build a solid case? Well, they follow the data. They follow the digital breadcrumbs. Regulators use incredibly powerful software to spot weird trading patterns. Like, say, someone's suddenly buying a massive amount of stock in a tiny company just days before a huge merger is announced. That's a red flag. Then they start mapping social and professional networks to see if they can link that trader to a corporate insider. And honestly, you won't believe this, but sometimes people get caught just because they can't resist bragging about their foolproof scheme. Now, this brings us to a really fundamental debate that's been raging for decades. Is insider trading really that big of a deal? I mean, if someone willingly sells their stock and someone else willingly buys it, is anyone really a victim? So on one side, you have this academic argument that it's almost impossible to find one specific person who lost money directly because of a single inside trade. I mean, the person who sold was probably going to sell anyway, right? But the market has a much bigger, louder answer. The real victim isn't just one person, it's the integrity of the entire system. It makes everyday investors, people like you and me, feel like the game is rigged against us. And when that trust is gone, the whole market suffers. That's the real damage. The rules we have today didn't just appear out of thin air. They were built over decades, case by case. Way back in '68, a landmark case established a basic rule. If you have inside info, you either disclose it to everyone or you abstain from trading. Simple. Then the '80s were just rocked by huge scandals like Ivan Boesky's, which exposed just how corrupt things could get. And that all brings us right back full circle to the Salman case, which really solidified the rules for the modern era we're in now. So where does all this leave us today? Well, the game certainly hasn't stopped, it's just evolved. Welcome to the new financial frontier. The things that keep regulators up at night today are a whole different beast. They're now facing threats that move at the speed of light, fueled by technologies that are creating brand new and really complex challenges. I mean, just look at what's on the horizon. We're talking about criminals using generative AI to create deepfake videos of CEOs to manipulate stock prices, or these coordinated pump and dump schemes in crypto markets that get amplified by thousands of social media bots. There's even cybercrime as a service, where sophisticated hacking tools are sold online, turning anyone with a grudge into a potential market manipulator. At the end of the day, it's a never-ending battle. It's a high-stakes, perpetual game of cat and mouse. For every new regulation that's put in place, clever criminals and new technologies find a way around it to get an edge. It is a constant race between those trying to protect the system and those trying to exploit it. And that leaves us with the big, lingering question for the future. In a world of encrypted messages, AI, and decentralized finance, that whisper of a tip can travel faster and more secretly than ever before. So can the laws that were written for a world of phone calls and briefcases ever really be enough to keep the game fair for everyone? Let me know what you think in the comments. I'm really curious to hear your take.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's gonna make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
Hey everyone, and welcome back to the Violet Vault. You ever see one of those investment opportunities that looks incredible, almost too good to be true, and you get that little pit in your stomach, that fear of missing out, that FOMO? Well, that feeling is exactly why we need to talk about something called due diligence. Today, we're going to flip the script on it. We're not going to treat it like some boring, tedious chore. We're going to treat it like what it really is, your personal superpower for investing with confidence and sleeping well at night. So here's our game plan for today. This is how we're going to build that superpower, one step at a time. First, we're going to get inside the mind of a scammer to understand their playbook. Then, we'll arm ourselves with a set of universal red flags to spot trouble from a mile away. After that, we'll put on our detective hats, and I'll even show you how to apply these skills to the Wild West of crypto. And finally, we'll bring it all home so you can walk away with a clear, confident path forward. Let's do this. All right, so first things first. Before we can build up our defenses, we have to understand the attack. And you know, it's probably not what you think. Why is it that smart, educated, careful people get scammed? The answer isn't about greed, and it's definitely not about being stupid. It comes down to something much more fundamental, something inside all of us, the human element. Take a look at this quote. This is from someone who actually lost their money in a real-life Ponzi scheme, and it is so revealing. Notice what they said. It wasn't about a slick sales pitch or some crazy promise. It was about seeing other people they knew, people they trusted, actually getting paid. A study on this very scheme found that this social proof was often the biggest single reason people finally decided to jump in. It just felt safe. And this is the truly brilliant and kind of scary part of the whole thing. Scammers don't just prey on our weaknesses, they actually weaponize our strengths. They take our natural trust in our friends and family, our confidence in someone who seems like a respectable person, our own optimism, and they turn it all against us. And get this, in that one study, every single one of the 17 victims heard about the investment from someone they knew. That just shows you how powerful and how dangerous our own social circles can be when these things start spreading. Okay, so we've looked at the why. We get the psychology now. So let's get into the what. What are the actual, tangible warning signs you can spot out there in the real world? Think of this next part as your official field guide to spotting fraud. The Canadian Securities Administrators put together a fantastic checklist, and these are some of the biggest hits. You got the high-pressure sales tactic, you have to decide right now. Then there's the promise of guaranteed high returns, which, let me tell you, is almost always a lie in investing. They might try to make you feel special with an exclusive offer just for you. If you hear any of this stuff, your internal alarm bells shouldn't just be ringing, they should be screaming.
So how do we actively defend ourselves against all this? Look, it's not about becoming some super cynical person who trusts no one. It's about becoming a strategist. The antidote to all this manipulation, the very core of our defense, is a powerful process called due diligence.
Okay, I know. That definition sounds a little dry, right? Verifying operational infrastructure. But just think about it like this. You wouldn't buy a used car without popping the hood, checking the engine, and taking it for a spin, would you? Of course not. Well, due diligence is just doing that for your investments. It's looking under the hood, checking out the people, and understanding the process to make sure it's not just a shiny paint job covering up a rusty engine. But here's a really important modern twist on this whole idea. The old way of thinking about due diligence was like it was a one-time report card. You check it once, you file it away, and you're done. The new way, what some are calling ODD 3.0, sees it as a constant, active, real-time process. The big takeaway here is that due diligence isn't something you did, it's something you do. It's a verb, an ongoing action, not just a noun. All right, now this is where it gets really fun and honestly really empowering. We're moving from the what to the how. How do you actually do due diligence? Well, it's time to put on our detective hats, because as you're about to see, the tools of an investigator can be both surprisingly simple and incredibly creative. So on one end of the spectrum, you've got the super formal approach. Regulators like FINRA, that's the Financial Industry Regulatory Authority, they give professional brokers these detailed checklists. They're asking the tough, nitty-gritty questions about things like internal audits, business plans, the background of the management team. This is the heavy-duty, by-the-book investigation. And then you have this,
You gotta love the creativity. This is from a real investor's blog. He was thinking about investing in a company that owned a dating site. So what did he do? He created a fake profile. He wanted to see for himself if the product actually worked and if real people were using it. Now that is thinking like a detective, getting your hands dirty and verifying the claims for yourself.
So what does your personal detective toolkit look like? Well, it's way more accessible than you might think. You can use free online tools like FINRA's Broker Check to see if an advisor has any red flags in their history. You can hop on LinkedIn to see if the CEO's resume actually checks out. You can just talk to a smart friend who knows the industry and run the idea by them. They might see something you miss. And you can actually read the documents and notice if the story keeps changing from one filing to the next. These are all powerful steps that literally anyone can take.
Okay, so let's take this new detective mindset and apply it to one of the most exciting and, let's be honest, one of the most dangerous frontiers in finance today, the world of Web3 and cryptocurrency. This is an arena where the promises are absolutely massive, which means our level of scrutiny has to be even higher.
I mean, the story of Web3 is built on these incredible world-changing ideas, right? The promise of a truly decentralized internet that's owned by us, the users, not by giant corporations. The promise of indisputable digital ownership, and this idea of trustless systems where code is law. But when you start digging, critics point to a much more complicated reality. A lot of these so-called decentralized apps, they actually rely on a few big centralized companies just to work. And that digital ownership, it's often just a line in a contract, not something legally protected like owning a house. And that code is law idea, well, that falls apart real fast when a hacker finds a bug in the code to exploit. This quote from the technologist Moxie Marlinspike just nails the core of the issue. He dug into it and found that, in reality, almost nobody wants the hassle of running their own server. So to make everything easy to use, most of these decentralized apps have to funnel everything through a couple of big centralized companies. This is a perfect detective move. He uncovered that crucial gap between the marketing pitch and how the technology actually works.
Okay, so we've pulled apart the psychology, we've learned the red flags, and we've assembled our detective's toolkit. So how do we bring this all together into a mindset that protects us for the long haul? Let's map out the final path from being a potential target to becoming an empowered, confident investigator. It really boils down to these 4 simple steps. Number 1, just acknowledge your own biases. Understand that those psychological pulls we talked about earlier, they affect every single one of us. Second, learn those red flags until spotting them is like second nature. Third, actively put your detective's toolkit to use. And finally, and this one is so important, maintain a healthy skepticism. Now that doesn't mean being negative or cynical, it just means developing the simple habit of asking one question for every investment. How can I verify this for myself? And that brings us to the end. I want to leave you with one final thought, one question to get you started. Put on your detective hat right now and think about your own investments. What is one core assumption you've made about something you own that you have never, ever actually tried to verify for yourself? The answer to that question? Well, that's where your first investigation begins. Let me know in the comments. What's the first step you're going to take after watching this? I'd love to hear it. Thanks so much for hanging out, and I'll see you next time.
Thank you for spending time with us here at the Violet Vault. Don't forget to like, subscribe, and drop your thoughts in the comments below. I'd love to hear from you. Until next time, stay focused and keep growing.